Most people think trading is just buying and selling, but the reality is far more nuanced. When it comes to financial markets, the strategies you choose can drastically change both your potential returns and risks. Two of the most common approaches are spot trading and day trading. At first glance, they might look similar. You buy an asset, watch the charts, and sell. But the mindset, time commitment, and risk management involved are very different. Understanding these differences is essential if you want to trade successfully or simply invest your money wisely. Today, we're breaking down spot trading versus day trading, what they are, how they work, the pros and cons, and how to know which approach is right for you. What is spot trading? Spot trading is the most straightforward form of trading. When you engage in spot trading, you buy an asset, like a stock, cryptocurrency, or commodity, and you own it immediately. The transaction happens on the spot, hence the name. The price you see is the price you pay, and ownership is transferred instantly. Spot trading can be done on a variety of markets: stock exchanges, crypto platforms, Forex markets, or commodities like gold and oil. You typically hold the asset for a longer period, anywhere from a few days to several years. This approach is less about timing the market perfectly and more about identifying assets you believe will grow in value over time. Because spot trading doesn't require rapid buying and selling, it's generally less stressful and allows for more thoughtful decision-making. It's ideal for investors who prefer a slower, strategic approach to wealth building. Spot trading example. Let's say you buy 10 shares of a technology company at $100 per share. You now own those shares directly, and if the stock rises to $150, you can sell and capture the $50 profit per share. Conversely, if the stock falls to $80, your holdings lose value, but you still own them. Unlike day trading, spot trading doesn't require you to act immediately on short-term market movements. You can ride out volatility, wait for the market to recover, or adjust your strategy over weeks, months, or even years. Advantages of spot trading. Simplicity. You buy, hold, and sell. It's straightforward and easy to understand. Lower stress. Since there's no need to monitor the market constantly, emotional decision-making is reduced. Long-term growth. Spot trading aligns with long-term investment strategies, making it easier to take advantage of compounding gains. Lower costs. You pay fewer transaction fees compared to frequent buying and selling. Disadvantages of spot trading. Slower profits. Since spot trading relies on long-term appreciation, it may take months or years to see significant returns. Market risk. Holding an asset exposes you to market fluctuations. If the market crashes, your investment loses value. Less leverage. Spot trading usually involves paying the full price of an asset, unlike some leveraged trading strategies. What is day trading? Day trading is almost the opposite of spot trading. In day trading, you buy and sell assets within the same day, sometimes within minutes or even seconds. The goal is to profit from small price movements rather than long-term appreciation. Day traders use charts, technical indicators, and market patterns to make decisions. They often trade stocks, Forex, cryptocurrencies, or commodities that have high liquidity and volatility. The short-term nature of day trading requires constant attention, quick decisions, and precise execution. Day trading example. Suppose you identify a stock that fluctuates between $100 and $105 in a single day. A day trader might buy at $100.50 and sell at $104, capturing a small but consistent profit. This process is repeated multiple times throughout the day. By leveraging small price movements, day traders aim to compound small gains into significant overall profits. Advantages of day trading. Potential for quick profits. Large profits are possible in a short time if trades are successful. Market independence. Day trading profits aren't reliant on long-term market trends. They capitalize on short-term fluctuations. Flexibility. You can trade in various markets as long as liquidity is high. Disadvantages of day trading. High stress. Constant monitoring of charts and prices can be mentally exhausting. Increased risk. Short-term trades are highly unpredictable, and mistakes can lead to significant losses. Higher costs. Frequent buying and selling incurs more transaction fees and spreads. Time-intensive. Day trading often requires full-time attention, making it difficult to combine with other work. Spot trading vs. day trading. Key differences. Time horizon. Spot trading is long-term. Day trading is short-term. Ownership. Spot trading involves actual ownership of the asset. Day trading may involve owning the asset for only minutes or using leveraged positions. Stress level. Spot trading is lower stress. Day trading is high stress. Capital requirement. Day trading often requires larger capital or leverage to make meaningful gains. Spot trading can start with smaller amounts. Skill level. Spot trading requires research and patience. Day trading demands technical skill, quick decision-making, and discipline. Who should do spot trading? Spot trading is ideal for beginners or those who prefer a measured, strategic approach. If you're new to markets, don't have hours to spend analyzing charts, or prefer less stress, spot trading is likely better. It allows you to learn, make mistakes without catastrophic losses, and focus on long-term growth. Who should do day trading? Day trading is suited for experienced traders with a high tolerance for risk and strong analytical skills. You need to understand technical indicators, market behavior, and risk management. Day trading is not a way to get rich quick without preparation. It requires discipline, strategy, and constant learning. Common mistakes in spot trading. Buying without research. People often buy assets based on hype instead of fundamentals. Panicking during volatility. Spot traders who sell during dips miss potential long-term gains. Ignoring diversification. Putting all money in a single stock or asset increases risk. Common mistakes in day trading. Overtrading. Trading too frequently can lead to mistakes and high fees. Ignoring risk management. Failing to set stop losses can result in devastating losses. Chasing losses. Trying to win back money often compounds losses rather than fixing them. The importance of education. Regardless of which method you choose, education is essential. Learn about market fundamentals, technical analysis, risk management, and trading psychology. Beginners benefit from practice accounts or simulated trading before risking real money. Continuous learning separates profitable traders from those who fail. Understanding spot trading versus day trading is the first step towards smarter financial decisions. Both have potential, but success comes from strategy, discipline, and education. Know your goals, understand the risks, and choose an approach that aligns with your financial plan. If you found this guide helpful, make sure to like, subscribe, and hit the notification bell for more insights on investing, trading, and wealth-building strategies.